Hi, guys. Okay, we're 0 for 2. We have electricity power outage. We have internet power outage or internet down. So we're going to give this another go. Thanks, Mark. There's a few people still on the call. So what we're going to do is we are going to do the call, and we're going to send it out to everyone. So hopefully people get it. So where I was in the call was talking about our year last year, and I mentioned that it was my favorite year of my 35 years in the business, and not just because it was our best return year, but it was our favorite year because I think that what I love about this business is, to me, it's a giant puzzle. And the puzzle that we had under COVID was the most difficult puzzle there was to solve. And, what we did is we had to really dig down in history, looking at previous pandemics, but also listening to the US Fed, watching money supply. And it's very rewarding that we came out of that very, very well. So it was a great year from that perspective. It's also very, very gratifying, and we're very proud as a team to be recognized by #1 by Wealth Professional, which is our industry magazine, and then #2 in Canada. So we have a 1 and a 2 ranking, which we'll take the gold and the silver medal any day. So we're very, very proud of that, and it's nice to be recognized. Lastly, I was talking to a client of mine who he opened an account in 1992 or 1993, and this is a guy that bought Canada savings bonds through me. They were yielding 7%. They were cashable. It was a great deal. And he's been with me ever since. And this is an account that was, it was a good size. He had sold some real estate, downsized, and it was well under $1 million. And that account today is over $4 million, and he's been taking some dividends and some income out of it. So it's very gratifying to us to make a difference in people's lives, and that's what keeps me going. So thanks again for all of that. So, I'm in the business of what have you done for me lately? So we will bask in the glory of last year, and then we will roll our sleeves up and try to answer the question, what the heck is going on in 2022? Because 2021 is over. Now, one of the tools that we use is is the sentiment indicator. And this is an important tool because I want you to think about, and I've used this analogy before, I want you to think about a swimming pool, and there's a water level in it. And the more people that jump into the pool, the more the water level goes up. And if everybody jumps out of the pool, the water level goes down. And so, Wayne Gretzky was the greatest hockey player to ever live. And he made an interesting statement. I pass to where the player is going to, not where he is or where he has been. So it's our job to find out not what happened last year. That is a very, very poor way of making investment decisions. Or where we are today is where are we going? So one of the tools that we use is at extremes. When the data says everyone is already in the swimming pool, by definition, the water level is it's very tough for it to go even higher because they're all in. And if everybody's out of the pool and you go, well, I think, the sun might shine again and everyone might jump back in, then you've got a much higher probability of the water level going up. So I'm going to show you some interesting things that we have seen throughout the years, and clients that have been around for 20 or 30 years are going to recognize some of these things. So Am I doing this right? Am I sharing, Mark? Do you see the sentiment numbers? So if you can remember back in 2000 and early 2000, late 99, LePoidevin Group clients didn't own any technology shares. We owned no Amazon, no Microsoft, no Nortel. The market valuations were absolutely ridiculous. But one of the things that stood out in early 2000, we had the highest percentage, and this is a weekly survey that comes out, and they ask people, are you bullish? Are you negative? Or are you neutral? So bearish means negative, bullish means I'm positive on the stock market, neutral means neutral. So in January of 2000, now think about the 100 people that are standing outside the pool. 75 are in the pool out of the 100. 11 are in the ladder and they're halfway up. They can't decide, am I going to go swimming or am I going to get out? So there's 11 out of the 75, and there's 13 people that are not in the pool and they are not going in. Now that was the most skewed in history in terms of I'm getting in the pool, I'm bullish, it's sunny, I want to go swimming. And so that by definition said the water level really was going to be very, very hard to go up. So as a tool, it's very interesting. Now, if I continue to show you some things, I want to fast forward to 2009. Now, the US banks had just failed. It looked like we were going to have a Great Depression. Unemployment we were losing 1 million jobs a week. So that was March of 2009. So the previous peak was about 90 days from the peak of the market in 2000. This actually was the bottom of the market, where just 18 people are in the pool and 70 are outside and 10 are halfway up the ladder. That was the most skewed. So by definition, people were out of the market, okay? So I can show you the 09 bottom, and there's the panic of the COVID panic, where we had just 20% of the population bullish of stocks, a lot of neutrals, ironically, and 48% bearish. So I've charted this back to 1987. And what we have here is the extremes, okay? And so if you look at the chart and you look at the year 2000, you can see in that chart, I've put a red arrow down. That was that highest, most bullish reading. So people are all in, everybody is playing the stock market, and we had a strong sell signal. What's also very interesting is that especially the technology index began to blow up, and stocks were declining. And then in September, they began to go up dramatically. And then people got wildly optimistic. And so what that indicator said is stay out. Well, the market fell dramatically, especially in technology. And we got a buy signal in 2002, which said, and by the way, the market fell consecutively on 2001, 2002. And that buy signal came because we went from 75%, the market's going higher, to the sentiment said just 20% of the market's going higher. So in 2002, you got your buy signal. Now, again, sometimes we got a sell signal in 03, 04, and then you got a buy signal again. So, listen, we're going to talk about a few things today, but in the mix, I don't really know of another indicator that is better. Now, notice that it got us in on COVID. Notice that it missed the sell signal before the 09 crisis, but it certainly got you in at the bottom. It got you in COVID. And it's interesting that we had a buy signal in COVID. Well, we had another buy signal when the second wave hit, or I don't know, the second or the third wave or whatever, whichever wave, people got very negative. So it said, stay in the market, because that was in 2020, late 2020, the markets had already rallied. It said, stay in the market. And what's really interesting now. And by the way, I'm just going to go all the way to the left. By the way, we just got the 1987 crash in there, and it gave us a sell signal just before the crash. But what's interesting now is that here we are, January 2020, and the markets have corrected. We are as negative today as we were in the COVID bottom, which says if you're just looking at this indicator alone, you say, wow, it's negative, it's washed out. We were expecting a correction, and therefore we got it. And you tend to bottom these corrections when people start to get nervous. And we have had a tremendous amount of calls in the last few days about people very worried about the markets. And, you know, so that's showing up on this survey. So that's one of our tools. Now, it's not quite as simple as there's 100 people in the pool and we have to decide whether they're going out. Unfortunately, there are actually 5 swimming pools. And so there's a whole bunch of people, and we have to guess, are they actually going to leave and hop the fence and go into one of the other swimming pools? And so of the 5 swimming pools, one is called cash. And cash is, you know, high interest rates, short-term GICs, short-term corporate debt instruments. Another swimming pool is called bonds, and those are government, corporate, or private lending. Now, we've been talking about the swimming pool called equities. Are you in or out? So, of course, within the swimming pools, there's a deep end and a shallow end. There's domestic, US, and global. Another swimming pool is, of course, you know, if all else fails, there's real estate, residential, commercial. You can go around the world and buy real estate. And now, you know, then there's an alternative. You could just say, I don't want real estate, I don't want stocks, I don't want cash, but I'm going to put my money in crypto, or I'm going to put my money in art, or I'm going to put my money in gold. And so from a perspective, we've said in our calls that we have to say, where is the money going to? So what is in fact going on here? Now we have been warning for a while. Now, it's very interesting that, and we said in our December call that this market is due for a correction, and we even had the reason that it was due for a correction. And the reason it was due for a correction is the market would have a reason to sell early in the year, and that would be a little bit of a hissy fit about the Fed is going to start raising rates. It was only 6 months ago that the market thought that rates might go up in 2023, not 22, 23. Today, and just a couple of weeks ago, we thought maybe the Fed will raise 3 times. Well, today we've moved to a 5 times increase. And so what is going on today is that the markets are waking up to the fact that interest rates are going higher off of the zero bound. And why this is a negative for stocks, if we go back, rising interest rates, it all of a sudden takes that cash pool and the swimming pool, it's starting to make it look a little more attractive. The sun is shining on our pool being equities, but wait a minute, the sun may be shining in cash, because if cash starts to go up and up and up, that's going to start to pull people out of our swimming pool into some of the other pools. And as you know, we have we follow the Marty's Wag rule, which is don't fight the Fed. And one of my clients asked an excellent question, David, aren't you fighting the Fed? The Fed has said they're going to raise interest rates. And so let's hold on for a second here and talk about this, because what we're going to do is we're going to look at when interest rates began to rise. So these are the other cycles where we saw the first rate increase. Now we know it's coming, so it's going to come in March. But if we look back, for example, in recent memory, 1994, this was not, the market had a rough year because they were very worried about rates going up. But 1994 was not a recession. It was in the middle of an economic cycle, which went from 1991 to a recession in 01. We were in the 40% of the way through. It was a terrible indicator to say, sell all my stocks. June of 2004 was a terrible time to get it out of stocks, because we didn't get out of the market when the interest rates began to rise in 04, and rates were down to 1.25%. 10-year bonds were 4.5%, and rates began to rise in 04. December of 2013, let's remember, market went up till 2020. Yes, it had some hiccups, and we had Trump, we had a whole bunch of corrections. But at the end of the day, 2013 was a terrible time to sell stocks because rates were going to go up. So what is it when we say don't fight the Fed? When the Fed goes from 0 to a quarter, that is still what we call accommodative. That is still very conducive to an expanding economy. The brakes go on after successive interest rate increases. So we're at the beginning, but is this 2013? Is this 2004? Now, the one I skipped over conveniently was December of 1986. So let's call it almost 1987. Remember what happened in 1987? Stock market crash. So is this 1987 or is this 2013? And in 1987, the US Fed began to raise rates. But if you can believe it, they were not raising rates 0.25% at a time. Every 6 weeks, they were raising rates 1% per meeting. Now, the reason I can't give you exactly what's going to happen this year is right now the US Fed has indicated that they are going to begin a rate rising cycle. And that gives us lots of time. It may mean there's a recession in 2024, but we shall see. If the indications are that the Fed is going to start raising 0.5% per meeting, and they meet every 6 weeks, or 1% per meeting, we will have a 1987 on our hands. But let's remember, the market did not crash until October. So from December, we still had 10 months. So that's from the first rate increase. So we are talking March. The shortest duration of a disastrous market was 10 months. We are talking 2 months away from the US Fed raising rates. So we are potentially talking about, a real disastrous market at the end of this year, or it might be 2 or 3 years. Stay tuned, because we know we don't fight the Fed. I do want to point out on this chart where interest rates began to rise. In 2013, we were off of 09, so they were also US Fed funds. When we say 0.25, that's the rate that they lend to the banks. But really, interest rates were 0. 10-year yields were 2.9. But it's interesting, if we look at unemployment claims, they were running at 330. So claims, they were running at 330,000. We're better than that. So the lower the unemployment claims, the better. The unemployment rate, when they started to raise rates in 2013, was 6.7. It is now 3.9. So you can tell, it's time. Business hiring, the higher the number, the better. Look where we are compared to other cycles when we start. Job openings. Look at our inflation rate. Now this is core, so it's actually higher than that. US is running 7, but if you took out energy and food, for those of you that don't eat or drive, the inflation rate was 5.5, is 5.5 today. Core personal consumption expenditures running 4.7. There's many ways of gauging inflation. The US tends to like the one that understates inflation, but so we're running 5% inflation, and which is almost as high as 1976, where interest rates began to rise from a 5.88, 10-year bonds at 6.9 level. So interest rates have got a ways to go, but we are not by any means into a period where the Fed has yet slammed the brakes on. And that's a very important distinction. So look, here's where we are. The market has panicked to the point where, you know, they are almost at a level of pandemic lows in terms of fear. You know, look, I was looking at our clients. We're down a smidge this year. One, well, the S&P, when I was preparing for this call 2 days ago, was -9. The Nasdaq was -14, which is technology centric. The ARC Innovation Fund, which is measuring new technology stocks. It was sort of the poster child of the stock bubble. After losing 24 this year, it's down 27 in the first month of the year. Bonds are at -4 for the year. So we've been talking about this for a year. Rates are going up, money supply had surged, inflation was going to go up. Our portfolios are positioned for higher rates. You know, in the December call, I talked about 2 stocks. I said, you know, Tesla's a bubble. And by the way, Tesla's down 17% this year. I said 2 stocks were not bubbles. And I used just an example. I used Tech Resources and Manulife. Tech Resources up 13% this year. Manulife is up 6% this year. I'm not just talking about January year to date. Energy, by the way, which we said, you know, like this is, you know, we're too early to say the death of energy, up 16% this year after a tremendous year last year. So what we're seeing is a rotation away from bubble. One of the places to avoid, we talked about the 2001 meltdown of technology, rising rates. You avoid bonds, avoid technology, avoid high, it's not avoid technology. I should step that back. Avoid ridiculously high valuation stocks. Okay. Tesla's a great company. And by the way, it has not corrected yet to where I said it was a bubble in September. So do I think the technology correction is over? Absolutely not. This is going to be a very dangerous place to be. And it's very interesting that crypto is -20% and the poster child of crypto being Bitcoin. You know, and again, I can't comment on that. I don't really understand it. So to me, it's just a new asset class, but it you know, it hasn't been good. People have been piling into it without understanding it as well. So I do want to just jump back here, and Mark's going to handle the questions, but I'm going to handle the first question. And the first question is, I don't think there's a week that has gone by that I get a question. I'm thinking of helping my kids to buy real estate. And so I'm going to give you the answer. Most people ask the question and then they say, okay, send me $300,000. So they're really not asking. But I'm going to give you the answer that that I've been telling people, and you can listen or you can not listen. And if your child is renting or they're in a condo and they've got a baby on the way and they will really want to be in a house, the Bank of Canada mentioned 6 times in their press conference after their last decision, this was on Wednesday, on interest rates. They didn't raise, but they wanted to give you a stern warning that this is coming. So they mentioned 6 times that there's a significant shift coming. And that significant shift was the end of what they called end of emergency accommodation. They also mentioned we are in a path of rising rates, not we are going to raise rates once or twice. We are in a path of rising rates. They also mentioned we expect housing demand to moderate. Housing is a little bit like energy in the fact from a supply and demand curve, it's an inelastic supply and demand curve. And that means that a 2% change in demand can change the price tremendously. So I want you to think back in the last 40 years, we've had rate blips up in 81, 94, 2018, but we have not seen a long path of rate rises since 1981. And everyone talks about supply of house, not enough supply. Well, let's talk about the demand side, because the single greatest factor that affects demand is the interest rates, the cost of borrowing. Some people pay cash, but very few. It is almost always with some amount of borrowing. So on the demand side, I would just want you to ask yourself, you could borrow floating rate today, $1 million at $3,300 a month. Very, very, two working couples, young people, $1 million debt, very, very easy to borrow and should be no problem. Here in Houston, we have a problem maybe by next year at a 5% mortgage. That's $5,300. If you've borrowed 2 million, which is the 30-something, 40-year-olds, who has, 10,000 after-tax dollars. We haven't seen the delta of mortgages change to that extent since 1981. And so we are going to see a dramatic, if you're asking me, should you lend your money to a kid? I can't answer the dynamics of the family. But what I have seen is that people are jeopardizing their own retirement. We are not going to continue to make 25% a year. It's going to be a far more challenging year. I've said, I think we will scratch out a decent year. But that being said, people are taking, 300 out of their $2 million accounts. They're jeopardizing their own retirement, and they're helping their kids buy in to a bubble that is highly probable. I think the best case scenario is that interest rates go up and we have a 2019. Let's remember in 2019, rates were going up a smidge and house prices were down 10 to 15% in the bubble cities of Toronto and Vancouver. We are going to go way higher than that this time. And so where is the demand going to come from? The banks simply will not lend a young couple 1 million as the rates change, because the bank will do the math and say, oh, no, you qualify for far less mortgage today. So that's the first question. Mark's got a bunch more. How are we going to scratch out a good year? Look, I mentioned tech and Manulife are up this year. Energy's up. Our preferred shares are doing exceptionally well. They had a great year this year, and in a down market, they're up 2% this year. We love floating rate preferreds. And so if we look for now, stay tuned. Are we in a 1987? Right now, even the wording of the Bank of Canada and the Fed, we're starting at such a low rate. Rates go up a quarter, rates go up a half. They're still below 1. It's still very accommodative. So we say don't fight the Fed, US Federal Reserve Board, but the Fed hasn't actually put the brakes on yet. They said they're going to, but they haven't. So it would have been a shame if we had got all our clients out of the first rate rise in December of 2013. It would have left an exceptional amount of money on the table. Investor sentiment is at a extreme bearishness, which gives us a buy signal. So this is a market to be bought, not sold. I know it's kind of scary. And the knee-jerk reaction, by the way, since 1980, anytime you've had a market that's up 25%, the market has corrected every single time in January, because people inherently say, oh, we did really well last year. Let's take some chips off the table. It's kind of human nature. So in a nutshell, that's all I have to say, but we had some excellent questions this time. So I am going to pass it over to Mark, and I'm going to mute mine so we don't hear the double. Thanks, okay, guys.
Volume's okay, I hope. So yeah, we got lots of questions, more this time than I think in any other time. So if we didn't get to it, let me know. I'm going to start here, and I really like this question. I think it's really relevant to what's happening to start the year. And it says, why are expectations for higher interest rates and higher bond yields having a greater impact on growth stocks? So David touched on this a little bit. I just want to explain a little on the dynamic of why that's happening. So if we think about the stock market as a giant discounting machine, and I'll explain what that means. We're saying there's all these various companies making money, cash flow, revenue in the future, and we're trying to determine what's that worth today. What am I willing to pay today for that future stream? And you've got some companies making more today, and others are saying they're not making as much today, but they're going to grow a lot in the future. So that growth, when interest rates are at zero and the market is expecting it to stay at zero for a long time, there's less time value of money issue associated with saying, well, I'm not going to get as much money today, but so what? Rates are low. I'm not foregoing much. So I can pay for that growth, or I'm willing to, versus more predictable revenue streams. Now that interest rates are going up, what we call the present value, what I'm willing to pay for today is changing. The math is being altered dramatically. And so we've seen tech stocks and growth stocks suffer much more to start this year. And that's because expectations for interest rates and bond yields are rising. And so that's really, I looked at my screen and I've got a whole slew of, stocks that I'm following that are down 30, 40, 50% for the year. Very few of them have had a bad quarter or have materially adjusted their future guidance. It's just analysts and investors getting out their calculators and saying, okay, as interest rates go up, the present value of that future cash flow stream is getting adjusted. So I thought that was a really interesting question and a little bit of insight into why that dynamic is happening. And again, we've got the NASDAQ leading us slower today. Next question, can you discuss Russia-Ukraine conflict and how that might impact markets? So let's just talk about history a little bit. If we go back to, say, World War II, from the period of 1939 to 1945, equity markets were actually up 50% or 7% per year. So a little counterintuitive. I looked at sort of conflicts from 1950 on. We actually get average drawdown of about 5%. There's a big range in there, but the summary is those events tend to be more corrective in nature. And so I think it's fair to say for this year, some of the damage that's been done market-wise is much more a result of what the Fed is doing and what interest rates are doing than what's happening in Russia and Ukraine. Now, it's worth following. I think the obvious impact is what's happening. You can see, Ukrainian and Russian-denominated bonds are the lowest within their peer group in terms of where they're trading. In terms of emerging market currencies, Ukraine and Russian ruble are the lowest within that emerging market group. I think for us, we would look at some of the potential byproducts if tensions continue to escalate. Those regions, the Black Sea region is a major exporter of grains and corn and wheat. So if tensions escalate, if there's sanctions applied, we could have the potential for food shortages, more inflationary pressures. The other aspect is obviously Russia, big exporter of natural gas and energy. So again, sanctions, conflict could lead to potential higher prices, but we would look at some of the more second and third derivative, byproducts of that, as opposed to what the result would be of the whole market. Okay, another question. This individual, I won't ask it verbatim because there's some account specific stuff, but basically I've got an account with a high exposure to preferred shares. I was wondering how you and your team plan to address that with the anticipated rise of interest rates. Great question. Let's remember in terms of our client accounts and what we've been doing with clients as far as preferred shares go, there are really two main types of preferreds. We have perpetual preferreds and we have reset or floating preferreds. Each of those perform differently in a sense in terms of how interest rates, in terms of the interest rate environment and the perception for where interest rates are going. So when we started buying preferreds way back in 2009, our view was the economy would be sluggish and rates would remain low. So we stayed predominantly in the perpetual preferreds, perpetual being preferreds that have a dividend attached to it that doesn't necessarily reset or change as long as the preferred issue remains trading. The resets and floaters, on the other hand, do have a mechanism by which the dividend changes. Therefore, if interest rates are rising or the perception is they'll continue to rise, reset and floating rate preferred should perform well, which a lot of our clients saw, happening last year. And so when we look at what's happening in a rising interest rate environment this year, we've got bonds, which in terms of the bond funds I follow, are down between 3 and 7% year to date, and our preferreds are hanging in really well. And that's a result of the majority of our exposure being focused in that reset and floating rate side of things. So, you know, I think David used the word sort of anti-bond in the sense that our floating and reset preferreds are positioned to do much better in a rising rate environment, you know, than bonds would be. So we feel pretty good about that. That's sort of it for me, Dave.
Awesome. Yeah, just to reiterate on preferreds, if you're in a floating rate preferred, which is where we are, 90% of our holdings in preferreds are floating rate. A rise in interest rates is good news. Pop the champagne. So that's it. If we've missed something, let us know. We'll have a call. If we're worried about the markets, let us know. Not everyone, please, but thanks again. And we'll see you next time. Sorry about all the technical issues, internet, power. But anyway, we'll see you next time.